Hello everyone, welcome to the 88th episode of me learning how to trade in Forex. So in the last video we went through how to trade using multiple time frame analysis, explaining what multiple time frame analysis is, which is simply the process of looking at the same pair and the same price but on different time frames. So for example the daily, the hourly or the 15-minute time frames. So reason using different time frames is because there are different market participants in the world, and every forex trader have their own different opinions on how a pair is traded, and everyone can be correct at the same time. So so looking at benefits of looking at multiple time frames, and basically each forex trader should trade a specific time frame that fits his or her own personality. And now we're on what time frame should I trade. So what time frame should I trade? Date is the 28th. What time frame should I trade? One of the reasons newbie traders don't do well as they should is because they're usually trading the wrong time frame for their personality. New forex traders will want to get rich quickly, so they start trading small time frames like the 1 minute or 5 minute charts. Then they end up getting frustrated when they trade because the time frame doesn't fit their personality. For some forex traders, they feel most comfortable trading the 1 hour charts. This time frame is longer but not too long, and trade signals are fewer but not too few. Taking on this time frame helps give more time to analyze the market and not feel so rushed. On the other hand, we have a friend who can never ever trade in a 1 hour time frame. It would be way too slow for him, and he'd probably think he was going to rot and die before he could get in a trade. He prefers trading a 10-minute chart. It still gives him enough time but not too much to make decisions based on his trading plan. Another buddy of ours can't figure out how forex traders trade on a 1 hour chart because he thinks it's too fast. He trades only daily, weekly and monthly charts. Okay, so you're probably asking what the right time frame is for you. Well, buddy, if you had been paying attention, it depends on your personality. You have to feel comfortable with the time frame you're trading in. So needs to feel comfortable trading in the time frame. Trading in the chosen. You always feel some kind of pressure or sense of frustration when you're in trade because real money is involved. That's natural. But you shouldn't feel that reason for the pressure is because things are happening so fast that you find it difficult to make decisions, or so slowly that you get frustrated. When we first start trading, we wouldn't stick to a time frame. We couldn't stick to a time frame. We started with a 15-minute chart, then the 5-minute chart, then we tried a 1 hour chart, the daily chart and the 4 hour chart. This is natural for all new forex traders until you find your comfort zone, and why we suggest that you demo trade using different time frames to see which fits your personality the best. Demo trade first to find out which time frame is the most suitable for you. Whoa. Did not mean to do that. What time frame is best for trading? Is best for trading. What time frame is best for trading? Well, just like everything in life, it all depends on you. Do you like to take things slowly, take your time on each trade? Maybe you're suited for trading longer time frames. Or perhaps you like the excitement, quick, fast-paced action. Perhaps you should take a look at the 5-minute charts. In the table below, we've highlighted some of the basic time frames and the differences between each. Right, so time frame, long-term, short-term swing, intraday. Description: long term. Long term traders will usually prefer to daily and weekly charts. Refer to daily and weekly charts. The weekly charts will establish a longer term perspective and assist in placing entries in the shorter term daily. Trades usually from a few weeks to many months, sometimes years. Advantage: don't have to watch the markets intraday. Fewer transactions mean fewer times to pay the spreads, more time to think through each trade. Disadvantages: large swings, usually one or two good trades a year, so patience is required. Bigger account needed to ride longer term swings, frequent losing months. Oof. Short term swing. Short term traders use hourly time frames to hold trades for several hours to a week. Advantage of being a short term trader: more opportunities for trades, less chance of losing months, less reliance on one or two trades a year to make money. Disadvantages: transaction costs will be higher, more spreads per pay, overnight risk becomes a factor. Intraday. Intraday traders use minute charts as 1 minute or 15 minutes. Trades are held at intraday and exited by market close. Advantages: lots of trading opportunities, less chance of losing months, overnight risk. Disadvantages: transaction costs will be much higher, more spreads to pay, mentally more difficult due to the need to change biases frequently. Profits are limited by needing to exit at the end of the day. Right. You also have to consider the amount of capital you have to trade. Right. So, long term. Daily and weekly charts. Short term hourly time frames. I hold trades for several hours. Hourly charts. Intraday minute charts. Frequently losing months. More times things trade through. You also have to consider the amount of capital you have to trade. Consider the amount of capital used for trading. Shorter time frames allows you to make better use of margin and have tighter stop losses. Larger time frames require bigger stops, thus a bigger account, so you can handle the market swings without facing a margin call. Shorter time frames allows the better use of margin and have tighter stop losses. Larger time frames require bigger stops, so a bigger account. The most important thing to remember is that whatever time frame you choose to trade, it should naturally fit your personality. If you feel a little comfortable, like your undies are loose on your or your pants are a little too short, then maybe it's just not the right fit. This is why we suggest demo trading on several time frames for a while to find your comfort zone. Demo trade on several time frames to find comfort zone. This will help you determine the best fit for you to make the best trading decisions you can. When you finally decide on your preferred time frame, that's when the fun begins. This is when you start looking at multiple time frames to help you analyze the markets. Right. Not above, below. Why should you look at multiple time frames when trading Forex? Why should you look at multiple time frames when trading Forex. Before we explain how to do multiple time frame analysis for your Forex trading, we feel that it's necessary to point out why you should actually flip through the different time frames. After all, isn't it hard enough to analyze just one chart as a Forex trader? You've got a billion indicators on, you've got to read up on economic news, you've got basketball practice, a Call of Duty session, a Fortnite session, a Dota 2 session, a hot date at McDonald's, then an hour viewing Instagram stories, and another 2 hours watching TikToks, etc. A long or short? Well, let's play a game called Long or Short to show you why you should be paying attention and put in an extra effort to look at different time frames. The rules of the game are easy. You look at the chart and decide whether to go long or short. Easy, right? Okay, ready. Let's take a look at the 10-minute chart of GBP/USD at 8 AM GMT. We've got the 200 period simple moving average on the chart, which appears to be holding as resistance. With price testing the resistance and forming a doji, it seems like a good time to short. Right? We'll take that as a yes. Looks like the 200 simple moving average has been holding. Time to short, so as in like the price is going to go drop that down again. But dang, look what happens next. The pair closed above resistance and rose another 200 pips. Ouch, oh well, too bad. Oh dang, resistance failed and price shot up. What happened? What the hell happened? Let's hop onto that 1 hour chart to see what happens. Wait, this is the 10-minute chart. If you had been looking at the 1 hour chart, you would have noticed that the pair was actually at the bottom of the ascending channel. What's more, a doji had formed right smack on the support line, a clear buy signal. So what the line we've seen here is the line around here, I think. So that bit there is that bit there, and then the rise is over here. Oops, it was actually at the bottom of the ascending channel. The ascending channel would have been even clearer on the 4 hour chart. If you had looked at this chart first, would you still have been so quick to go short when you're trading on the 10-minute chart? All the charts were showing the same price data, they were just different time frames of the same data. Do you see now the importance of looking at multiple time frames? We used to just trade off the 15-minute charts and that was it. We could never understand why when everything looked so good the market would suddenly stall or reverse. It never crossed our minds to take a look at the larger time frame to see what was happening. When the market did stall or reverse on the 15-minute chart, it was often because it hit support or resistance on a larger time frame. It took a couple of hundred negative pips to learn that the larger the time frame, the more likely an important support or resistance level would hold. Right, so the larger the time frame, the more likely an important support or resistance level would hold. You don't see the big picture. Trading using multiple time frames has probably kept us out of more losing trades than any other one thing alone. I think with using the multiple time frame analysis, when you do want to take a trade, would you zoom in? So for example, you look at the bigger picture, say like the 4 hour chart, and then you look at the 1 hour chart, and then you look at the 15-minute chart, and then you decide on whether to take the trade or not. Like say you work your way downwards. Is that the correct way to use the multiple time frame analysis? Or would you just use a 15-minute chart and then zoom out, so look at the 1 hour to confirm your 15-minute chart decision, and then zoom out again to the 4 hour one and then confirm your 1 hour, and then use that to confirm your 1 hour or 15-minute chart decision? I don't know. Trading using multiple time frames has probably kept us out of more losing trades than any other one thing alone, right? Yep. It will allow you to stay in a trade longer because you're able to identify where you are relative to the big picture. Most beginners look at only one time frame. They grab a single time frame, apply their indicators, and ignore other time frames. The problem is that a new trend coming from another time frame often hurts forex traders who don't look at the bigger picture. Yep. Use time frames. Use different time frames to look at the bigger picture. How to use multiple time frame analysis. How to use multiple time frame analysis to find better entry and exit points. No, we aren't about to break out into a song like the Glee cast. Here at babypips.com we've got our versions of a mashup which we would like to call the time frame mashup. This is where multiple time frame analysis comes into play. This is where we'll teach you how to not only lock in on your preferred trading time frame, but zoom in and out of charts so that you can knock a winner out of the park. Are you ready? You sure you can hack this? You've basically got a semester left of babypips.com School of Pipsology. You don't want to quit now, do you? Didn't think so. First of all, take a broad look at what's happening. Don't try to get your face close to the market, but push yourself further away. You have to remember, a trend on a longer time frame has had more time to develop, which means that it will take a bigger market move for the pair to change course. So, a trend on a longer time frame has had more time to develop. Meaning it will take a bigger market move for the pair to change course. Also, support resistance levels are more significant on longer time frames. Support and resistance levels are more significant on longer time frames. Start off by selecting your preferred time frame and then go up to the next higher time frame. There you can make a strategic decision to go long or short based on whether the market is ranging or trending. You would then return to your preferred time frame or even lower to make tactical decisions about where to enter and exit, play stop and profit target. Just so you know, this is probably one of the best uses of multiple time frame analysis. You can zoom in to help you find better entry and exit points. By adding the dimensions of time frame to your analysis, you can obtain an edge over the other tunnel vision traders who trade off on only one time frame. Did you get all that? Well, if you didn't, no worries. We're going to go through an example now to help make things a little clearer. How to perform multiple time frame analysis. Let's say that Cinderella, who gets bored all day cleaning up after her evil stepsisters decide that she wants to trade Forex. Very nice. After some demo trading, she realizes that she likes trading the Euro USD pair the most, and feels most comfortable looking at the 1 hour chart. She thinks that the 15-minute charts are too fast while the 4 hour takes too long. After all, she needs a beauty sleep. Fair enough. The first thing that Cinderella does is move up to check out the 4 hour chart of Euro USD. This will help you determine the overall trend. Clearly in an uptrend. She sees that the pair is clearly in an uptrend. This signals to Cinderella that she should only be looking for buy signals. After all, the trend is a friend, right? She doesn't want to get caught in the wrong direction and lose her slipper. Now she zooms back to her preferred time frame, the 1 hour chart, to help her spot an entry point. She also decides to pop on the stochastic indicator. Trendline, test, plus doji, stochastic crossover, so this is about to be a reversal point. Once she goes back to down 1 hour chart, Cinderella sees that a doji candlestick has formed and a stochastic has just crossed over out of oversold conditions. But Cinderella still isn't quite sure. She wants to make sure she has a really good entry point. So she scales down to the 15-minute chart to help her find an even better entry and to give her more confirmation. So the 15-minute chart, trend line holding. Stochastics also oversold. So now the Cinderella is locking her eyes on the 15-minute chart and she sees that the trend line seems to be holding pretty strongly. Not only that, but stochastic is showing oversold conditions on the 15-minute time frame as well. She figures that this would be a good time to enter and buy. Let's see what happens next. Entry area, uptrend continued, bada bing bada boom, all the way up to the sky. As it turns out, the uptrend continues, the Euro USD continues to rise up the charts. Cinderella would have just entered above 1.28, and if she kept the trade open for a couple of weeks, she would have made 400 pips. She could have bought another pair of glass slippers. There is obviously a limit to how many time frames you can study. You don't want a screen full of charts telling you different things. Use at least 2, but not more than 3 time frames. 2, but not more than 3 time frames. Adding more will just confuse the G willikers out of you and you'll suffer from analysis paralysis. Then proceed to go crazy. Is there a wrong way to do multiple time frame analysis, you ask? Some of our Forex friends have been nice enough to give their 2 pips on this matter through this forum thread on multiple time frame analysis. At the end of the day, it really is about finding what works for you. Right. Below, trading with 3 time frames. At the School of Pipsology, we prefer using 3 time frames. We feel that this gives us the most flexibility as we can decipher the long, medium and short term trends. 15-minute, 30-minute, 1 hour, 4 hour. Determine main trends. The largest time frame we consider our main trends. This shows us the big picture of the pair we want to trade. So 3 time frames to determine short, medium and long term price action. Largest or longest time frame is equal main trend. For example, on the daily chart, EURUSD is trading above the 200 simple moving average, which tells you that the main trend is up. Determine the current trend bias. The next time frame down is what we normally look at. So, medium time frame equals normal viewing time frame. And it signals to us the medium term buy or sell or buy or selling bias. Below is a 4-hour chart and it's clear that EURUSD continues to have a bullish bias. Signals the buy or sell bias. Below is a 4-hour chart considered bullish bias, so it's going to be going up. Determine entry and exit. The smallest time frame or the shortest time frame shows the short-term trend and helps to find really good entry and exit points. Define entry and exit points. So entry area, uptrend continues. Multiple time frame combinations. You can use any time frame you like as long as there is enough time differences between them to see a difference in their movements. You might use 1 hour, 1 minute, 5 minute, 30 minute, 5 minute, 30 minute, 4 hour. 15-minute, 1 hour and 4 hour, 1 hour, 4 hour and daily, 4 hour daily and weekly, so on. When you're trying to decide how much time in between charts, just make sure there is enough difference for the smaller time frame to move back and forth without every move reflecting in the larger time frame. If the time frames are too close, you won't be able to tell a difference, which would be pretty useless. When deciding the time frame differences, ensure there is enough difference for the smaller time frame to move back and forth without every move reflecting in the longest time frame. Okay, summary. Multiple time frame analysis. So now you're done. Now you can add multiple time frame analysis to your Forex trading toolbox. Using multiple time frame analysis allows you to get a bird's eye view. Here's a few tips you should remember. You have to decide what the correct time frame is for you. This comes from trying different time frames out through different market environments, recording results, analyzing these results to find what works for you. Once you found your preferred time frame, go to the next higher time frame, then make a strategic decision. To go long or short based on the direction of the trends. Then return to your preferred time frame or lower to make tactical decisions about where to enter and exit, place stop and profit target. Adding the dimensions of time frame to analysis gives you an edge over the other tunnel vision Forex traders who trade off on only one time frame. Make it a habit to look at multiple time frames when trading. Right. Choose a preferred time frame. Or is it select? Preferred time frame. Look at multiple time frames when trading. Make sure you practice. You don't want to get caught up in the heat of trading not knowing where the time frame button is. Make sure you know how to shift quickly between them. Heck, you should even practice having a chart containing multiple time frames up at the same time. Choose a set of time frames that you are going to watch and only concentrate on those time frames. Learn all you can about how the market works during those time frames. Don't look at too many time frames. You'll be overloaded with too much information and your brain will explode. And you'll end up with a messy desk since there will be blood spattered everywhere. Stick to 2 or 3 time frames. Any more than that is overkill. 2 to 3 time frames is enough. We can't repeat this enough. Get a bird's eye view. Using multiple time frames resolves contradictions between indicators and time frames. Multiple time frame analysis. Multiple time frame analysis can be confusing, but we're not about to let you graduate without knowing how to use it to your advantage. Multiple time frame analysis is simply the process of looking at a single pair or market on different time frames. Who among the following traders is doing multiple time frame analysis? Jessica, who is looking at 1 hour charts on Euro GBP, no. Megan, who's checking out Euro USD on 1 hour, 4 hour and daily charts. Yep. True or false? A trader's success or failure is not affected by the time frame on which he trades. False, right? Which of the following is the most important factor to help determine the time frame to trade on? Your personality. If you're a swing trader, which of the following is the most likely not one of your problems? The need to have a bigger account to ride longer term swings. Longer term traders usually focus on what time frames? Daily and weekly charts. Which among the following personality traits is the most critical for a long term trader? Cleanliness, yep, nope. Honesty, you have to be honest to yourself when your setup is invalidation closed, nope. Patience, yep. Let's play another round of long or short. GBP/USD forms a long-legged doji at the top of the ascending channel in the 15-minute time frame. Also, stochastic is indicating that the pair is already overbought, and the MACD lines just crossed over each other and look like they're heading down. What should you do now? Check out higher time frames. True or false, support and resistance levels would be more likely to hold in smaller time frames than in larger time ones. More likely false. Which of the following statement is true? A trend on a longer time frame has had more time to develop, which means that it will take a bigger market move for the pair to change course. The short key is likely the first one, I think. Yep. Something time frames are ideally used for deciding where to best enter a trade shorter. What's the most important thing to remember when you're trying to figure out what the best time frame combination for you? The more the better, so having a 5-second to monthly charts up on my screen is the way to go. Nope. Nope, there should be enough time to see a difference in their move. If you plan on just day trading, only look at smaller time frames. There should be enough time difference between them to see a difference in their movement. Oh, it's either one of the two, either the middle one or the bottom one. I think it's the bottom one. Yeah. Traders usually look at 3 time frames. If the longer time frame is used to determine trends and the shorter time frame is for entry and exit points, what is the use of the other one? It signals the medium term buy or sell bias. Utter perfection, let's go. Okay, undergraduate freshman, market sentiment. How's Mr. Market feeling? Every forex trader will always have an opinion about the market. It's a bear market. Everything's going to hell. Things are looking bright. I'm pretty bullish on the markets right now. Each and every trader will have their own personal explanation as to why the market is moving a certain way. When trading, traders express his view in whatever trade he takes. But sometimes, no matter how convinced the trader is that the market's moving in a particular direction, and no matter how pretty all the trend lines line up, the trader may still end up losing. A forex trader must realize that the overall market is a combination of all the views, ideas and opinions of all the participants in the market. That's right, everyone. This combined feeling that market participants have is what we call market sentiment. It is a dominating emotion or idea that the majority of the market feels best explains the current direction of the market. So, what is it? Market sentiment. The dominating emotion or idea that the majority of the market feels best explains the current direction of the market. Bull bear. How to develop a market sentiment based approach. As a forex trader, it is your job to gauge what the market is feeling. Are the indicators pointing towards bullish conditions? Are traders bearish on the economy? We can't tell the market what we think it should do, but we can but what we can do is react in response to what's happening in the markets. Note that using the market sentiment approach doesn't give a precise entry and exit for each trade, but don't despair. Having a sentiment-based approach can help you decide whether you should go with the flow or not. Of course, you can always combine the market sentiment analysis with technical and fundamental analysis to come up with better trade ideas. In stocks and options, traders can look at volume trade as an indicator of sentiment. If the stock price has been rising but the volume is declining, it may signal that the market is overbought. Or if a declining stock suddenly reversed on high volume, it means that market sentiment may have changed from bearish to bullish. Unfortunately, since the Forex market is traded over the counter, it doesn't have a centralized market. This means that the volume of each currency traded cannot be easily measured. What is this image? Gasp! Oh no, without any tools to measure volume, how can a Forex trader measure market sentiment? This is where the Committee of Traders report come in. Commitment of Traders report. Let's now learn about the Commitment for Traders reports. The Commodity Futures Trading Commission, or CFTC, publishes the Commitment of Traders report every Friday around 2:30 p.m. EST. So the Commodity Futures Trading Commission publishes the Commitment of Traders report every Friday around 2:30 p.m. EST. Because the Commitment of Traders report measures the net long and short positions taken by speculative traders, commercial traders, it is a great resource to gauge how heavily these market players are positioned in the market. Right, so the Commitment of Traders report measures the net long and short positions taken by speculative traders and commercial traders. It is a great resource to gauge how heavily these market players are positioned in the market. Later on, we'll let you meet these market players. These are the hedgers, large speculators, and retail traders. Just like players in team sport, each group has its own unique characteristics and roles. By watching the behavior of these players, you'll be able to foresee incoming changes in market sentiment. You're probably asking yourself, why the heck do I need to use data from the FX futures market? Doesn't the spot FX market have a report that measures how currency traders are positioned? I'm a spot Forex trader. Activity in the futures market doesn't involve me. Remember, since spot Forex is traded over the counter, transactions do not pass through a centralized exchange like the Chicago Mercantile Exchange. So, what's the closest thing we can get our hands on to see the state of the market and how the big players are moving their money? Yep, you got it, the Commitment of Traders report from the futures market. Before we dive into how to use the Commitment of Traders report as a Forex trader, you first have to know where to go to get the Commitment of Traders report and how to read it. Right. How to find the Commitment of Traders report. Here's how to find the Commitment of Traders report online. Step 1. Open up the address below in your web browser. https www.cftc.gov market reports commitment of traders index.htm. Step 2. Once the page is loaded, scroll down a couple of pages to the current legacy report and click on short format under futures only on the Chicago Mercantile Exchange row to access the most recent COT reports. Step 3. What's the difference in the short and long format? Step 3. It may seem a little intimidating at first because it looks just like a big giant gobbled up block of text, but with a little bit of effort you can find exactly what you're looking for. Just press Ctrl F or whatever the find function is of your browser and type in the currency you want to find. To find the British Pound Sterling or GBP, for example, just search up Pound Sterling and you'll be taken directly to the section that looks something like this. British Pound Sterling Chicago Mercantile Exchange. Futures only position as of 03/16/10. So this is the in UK time. So that's 16th of March 2010. Non-commercial, commercial total, long short spreads, long short, non-profitable positions, long short. Contracts of GBP 62,500, commitments 11,731 long, 755,718 short. Changes from that, change in open interest, percent of open interest for each category of traders, number of traders in each category, total traders 81. Yowza, what the heck is this? Don't worry, we'll explain each category below. Commercial, these are the big businesses that use currency futures to hedge and protect themselves from too much exchange rate fluctuation. Commercial. So commitment of traders report terminology. Commercial. Big businesses that use currency futures to hedge and protect themselves from too much exchange fluctuation. Non-commercial. Mixture of individual traders, hedge funds. Mixture of individual traders, hedge funds, and financial institutions. For the most part, these are traders who are looking to trade for speculative gains. In other words, these are traders just like you who are in it for the Benjamins. Long, this is the number of long contracts reported, number of short contracts, long shorts, yep. Number of long contracts, number of short contracts. Open interest. The number of contracts out there that have not been exercised or delivered. Number of traders. Total number of traders who are required to report positions to the CFTC. Are required to report their who are required to report positions to the CFTC. Reportable positions. Number of position options and futures positions that are required to be reported according to CFTC regulations. That are required to be reported to recorded according to CFTC regulations. Non-reportable positions. Number of open interests positions that do not meet the reportable requirements of the CFT retail traders. If you want to access all available historic data, you can view it here. You can see a lot of things in the COT reports, but you don't have to memorize all of it. As a budding trader, you'll only be focusing on answering the basic question: what the dilly on the market, yo? Translation: what's the market feeling this week? Okay. So what's the market feeling this week? Alright. I'm going to leave this episode here. My Wi-Fi has been cut out, it looks like. So in the next video, we're going to go through understanding the commitment of traders report. So thank you all for watching, and I will see you in the next video. Peace.